What's up, Tyler?
Winston, what's up, man?
All right. Well, excited to have another day chatting with you. We've got a good one today. I think it's really interesting. The Montessori school.
Yeah, it's nice, man. We've been looking a lot at these education daycare style assets recently. This one's a good one.
Yeah. So it's actually funny that we're doing this today. So I'll tell you a quick story. I had a meeting today, this morning, just before lunch, with a client of mine, and we met in a town about an hour and a half from here, we were speaking to someone who really knew the town well, and I actually had went to college with this guy's daughter. I didn't know it walking in, but I kind of thought about it and put the two together with the last names. Anyway, and he had told me that his two oldest daughters bought the Montessori school in their hometown. That was this morning.
That's cool.
Yeah. So it's really cool that we're going to be underwriting this today. So we'll change this up a little bit. As we talked about, we want to talk a little bit about the tenant more so than what we have in the past. And, so we'll start off just kind of talking about the Montessori school and who is actually backing this lease, right? So the name of the company that's running the Montessori school is called Higher Ground Education. It looks like they've had a valuation in 2021 of about $250 million. So they are operating the Guidepost Montessori School, which is the largest corporate Montessori school operator in the U.S. They've got 95 plus locations nationally, and they also have locations globally. It looks like their growth plan is about 40 locations a year, and they want to grow to about 500 locations by 2026. Right. So that's a pretty aggressive growth, especially for one corporate entity that is kind of I would say a franchisee. Again, I don't want anyone to quote me on whether or not they're a franchisee. I'm not 100% sure on the structure here of what they're doing, but I believe it to be something like a franchisee. What do you know about the Montessori school?
I mean, they might be a franchisee, but the thing is, Montessori isn't like McDonald's or Starbucks or something, right? Montessori is kind of a catch-all phrase used for a particular style of daycare and elementary school. So I would assume that they own this brand of Montessori, because anyone can really I can open a Montessori school. Let's call it Tyler's Montessori school. And there's no problem with that. I'm not a franchisee. I'm just using the name Montessori because I teach, with Montessori style methods, right? So I would assume that's probably their case. There's probably nothing bigger than the 250 million market cap, above them that they're getting that name from. Yeah.
Good. I knew you knew a little bit about this because we talked a couple of months ago about the Montessori school. So I knew you were kind of in the know, given you have young kids. So
yeah, I did my deep dive into daycares last year when I put my son in. So for the first time I heard the word Montessori, and then I did a deep dive for about 6 months into it. So
awesome. So so this is who's occupying the space. A very well-known brand, if you will. I'm going to use Montessori as a brand, kind of in that children's education space. What we're underwriting here is a brand new 20-year corporate triple net lease. It does have 2% annual increases. Let's see. It is in St. Augustine, Florida, out the Jacksonville area, and so the brokers here have it listed at a 7 cap at 8.47 million. They're claiming that the population growth within a 1 mile radius of this area will be about 29% through 2027, which is great. It's some fantastic growth. Really exceptional, household income in this area. I'll let you talk a little bit more on the location as well, Tyler. But overall, the Montessori school it is a really great brand. It looks like this is in a great market, very growing market. And so, yeah, that's what it is. So I'll let you take it over from here.
Yeah, let's just look at the real estate a little bit before we jump into the cash flows. So this is,
hang on, share your screen here.
Yeah, I'm going to share my screen here.
All right. It's still loading, Tyler.
Is that
all
flickering
right,
on your screen?
Ready. Yeah, it's flickering.
Yeah.
Oh, we're good. We're
okay.
We're in business.
Here we go. So you can see this, right? This is just south of Jacksonville, and it's actually not right in the St. Augustine beach area. It's in this little pocket here in the middle, which, you know, as Winston said, you've got a average household income, median household income of $150,000 a year. So this is kind of like a rich little pocket between Jacksonville and St. Augustine. And you've got basically, you know, houses, golf courses, rich folk stuff, and then all the kids stuff in one area, right? So you've got your medical, your doctors, whatever. You've got swim schools and karate classes and dance studios and everything. And then right up here, you've got your Montessori school. Okay. So this school is, you know, well located. It's in an area that's serving this community, you know, for this type of service, right? So this is probably always going to be an area that needs some type of daycare, elementary school, whatever. And another thing about this and I think about this only because, you know, in my own life, I'm doing the same logic, is when you look at the daycare school, you also want to look at the other schools that are coming down the road, right? So is there a good high school here? If there's a good high school just down the road, the chances that daycare is going to continue to stay there and serve the community is greater, right? So there is a good high school down the road. I think there's just a recent investment in that high school as well. A couple of $1 million were invested. You know, so basically this whole area is an area made to serve this higher end community. And, you know, if not this Montessori school, probably somebody else will use this as a daycare or some type of child services area in the future as well.
Yeah. So real quick to add on, like the market seems fantastic, right? I mean, average household income, 149. I'd really like to know what the median is, though. I don't like doing the average. But it says it's expected. I'm sorry.
Did Bill Gates pull that up? Was it? I thought I misread it. I thought it was median as well. Yeah, if they're doing the average, then maybe there's that like one rich guy that lives there and pulled up the whole neighborhood income.
Absolutely, but anyway, in this one, we would, if anyone is interested, I would definitely advise looking at median. But it's looking to grow by about 25,000 per household over the next 5 years. So that's great growth. So it's a really good location.
Yeah, very interesting area. I think this is actually a perfect area for someone else we know.
Yeah.
So let's dive into, let's look at the Excel sheet here. So Winston's talked a lot about this already. $8.4 million. So they're asking a 7 cap. So that means the net operating income is, $593,000 a year. It is a 20-year lease. It's brand new as of December. It's a double net plus. We like to call it double net plus. It was advertised as triple net, but the landlord is responsible for the building structure. So you do have to put some reserve away for that. And there are 4 or 5 year options on the end. So this school does actually control this piece of land if they want it for the next 40 years. So if they leave, it's their option, right? You shouldn't buy this property if you're thinking about, doing something different with it in the next half of your lifetime. So they control this for the next 40 years. As Winston was saying, it's backed by this corporation, 250 million-ish market cap. Apparently they haven't missed any rent on any of the 90 plus schools that they own. So, we were talking a little bit this before the call, but it's more difficult to underwrite these deals when it's a private company because you don't have the advantage of credit rating that you can compare directly to the bond market. But in terms of private companies, this is a pretty good sized company with a pretty good track record. So the discount you're going to use on their cash flows probably isn't going to be much different than a lower grade investment corporate bond or corporate company with a credit rating. Anything else here that's interesting before we move on?
No, no. I mean, we'll probably discuss more in depth private companies. I think it's really hard to kind of really evaluate the private companies, and that's why credit tenants get such, people are willing to pay such, accept a lower return. But there are ways. I mean, if you believe that education and a Montessori brand of education will flourish going forward, that's very powerful, and you can really go in and see how they're running these schools. Maybe spend a day, auditing the school or something if you're going to make the investment, to really just kind of see their operations, right? My guess is they've got to have pretty good operations to onboard 40 schools annually, right?
Yeah.
So anyway, I don't want to spend a lot of time on that, but no,
but you're right. They've got to be really streamlined. So let's open this real quick. Operating and acquisition cash flows. This is the simplest part of any analysis, really. If your Excel sheet doesn't freeze, it's the simplest part of any analysis. Let me just open that again. There we go. Okay. So as we said before, right? They're asking a 7 cap, which puts us at 8.4 million. You assume, 1% or so on closing fees. You're getting 2% rent bumps a year, which is great. That's about the best you're going to get in most of these assets. I've seen 2.5%, but it's very rare. Usually you're going to get something like 10% every 5 years or 2% a year. You do need to put away a bit of a capital reserve for this. I'm using 30,000. We're looking at about 5% of the NOI per year for structure. It might be, it's a large building, 12,000 square feet. I don't know if that's maybe a little high, a little low. You'd have to analyze it a bit more, I think, to get a more accurate number there. But, ballpark 5% of NOI should be reasonable. So when we, aside from the acquisition and operating cash flows, really the most important thing to analyze is the disposition cash flow. So this is always more complicated than acquisition and operating, right? So, and this is where the private company factor comes more into play. So when we look at this, for example, we're going to use year 10 as a disposition year. In year 10, you're either going to still have this tenant and they're going to be under contract for another 10 years, or you're not, right? And if you're not, what are you going to do? So if you're not, what are you going to do is very important on these assets where the tenant might leave, right? Where the tenant doesn't have a real corporate credit rating, where there's a real chance that maybe you're going to have to re-tenant this thing. So in this scenario, what's really important is we analyze the market, we analyze the site, and we analyze the industry, which we talked about all that at the beginning of the call, right? So this site, this market, and this industry, they all look good. So we can have less fear in the scenario where the tenant leaves than if we were in, the middle of nowhere with a crappy site and good cash flows. And then all of a sudden those cash flows dry up and we're hung out to dry, right? So the two scenarios I've got here, one is where they stay. The net income at that point should be about $720,000 a year. And I'm using an exit cap rate of 7.5. That's a 5 basis point increase off the asking cap rate per year, just for wear and tear of the building and, a shorter lease term that the tenant would have at that time. And then for when the scenario 2, where the tenant leaves and you have to do an adaptive reuse, I'm using the same market NOI that these guys are paying now, but I'm taking off $100 a square foot for the cost of adaptive reuse. So that's a $1.2 million adaptive reuse. And you can see the difference there in your net proceeds from disposition for the two scenarios. What do you think about that? What are you thinking here, Winston, disposition wise?
Right now with the changing of the markets, it's really tough to tell. I think it's very fair in scenario 1 to say 7.5, cap. Like I think that's very fair. But look, it could be lower, right? I mean, it could be lower. So no one knows. No one has a crystal ball. I think that's good. I think that's right in line with what I would try to predict there. But again, no one has a crystal ball on cap rates. In scenario 2, I think that's pretty good. You're going to be looking for a similar use type. we'll be looking for some sort of school, some sort of daycare, something like that, if you're going to do an adaptive reuse. So I do think that the $100 a square foot's a little healthy, but I don't think we should change it right now. I think you can keep it as is for the purposes of this exercise.
Okay, great. So yeah. So
wait, Tyler, one question I had though is, what if we just as is, right? Like, so how if we bought it for the 7 cap right now, what would be, how would we cash flow it? That's a question that I had is how do we cash flow it? Just as is 7%. We buy it at a 7 cap.
Yeah. So if we were to buy this at a 7 cap, these are the cash flows you're looking at over the next 10 years. With the assumptions above, right? This is unlevered, so you'd be in for $8.5 million. You can see your cash flows there. Year 560. With those 2% bumps, get up to about 660, and then the 9.7 million reversion on the end, right? That's the NOI for that year plus the disposition, right? If you play around with that with leverage, right, you can. So here you can see the unlevered IRR is 7.5%. What does that mean? Over 10 years, unlevered, you're getting about a 1.8 x return on your capital, right? That's multiplier on invested capital. If you were levered, and you can play around with this, let's say you had, now it's at 50%. Let's say you took out a 60% loan. You're in for 3.5 million. Well, you're still cash flow positive here. Until the end where you cash out that 5.3 million, and you're getting just over a 2x multiplier on your money over 10 years. Right?
Okay. Yeah, great.
So the good news here is, in this environment, it's tough to find these, but the good news here is your unlevered IRR is better than your loan rate. So you do have positive leverage here. So you can actually lever this thing up pretty good, and you won't run into negative cash flows. I think you'd have to get pretty deep into leverage to have negative cash flows. Yeah, no one's ever going to prove this, but you'd have to be like 90% levered to get into negative cash flows. So you're going to cash flow positive here with any realistic loan that you're going to take out today. So really, you just want to customize the amount of leverage to how much money do you have? How much money do you want to put into this deal?
Yep. Yeah. Well, that's good. I think, it's kind of comforting to see this. A lot of what we've been underwriting has not been cash flow positive, so that's good.
And one other thing to talk about, right? You talked about the exit cap rate. We don't have a crystal ball. These are just, this is just a small sensitivity analysis, right? We use a 7.5 exit cap up there. That gives us, in this scenario, an 8.3 IRR. But if that cap rate, was down closer to what we're buying it at, if we got down to 6.9, well, now we're, at a 9.3 IRR. And if that cap rate, was worse, up to 8.1, well, we're still in the 7s. So, even with some flexibility in that cap rate, we're getting decent returns on this asset. So we're in that 7 to 9 IRR range, which is quite reasonable for an asset with this risk profile in today's market.
Yeah, cool.
And the last thing I just wanted to pop up here, I like to do this, is, so these are, comps from the last 6 months of daycare and educational facilities, right? So you can see this up here in orange. This is, it's definitely an outlier, right? 7 cap with 20 years on the lease. Most of these other ones are down in the 6 range. So this is definitely an outlier. It's about 100 basis points higher than you would expect just from this graph. So, you have to ask, why is that? Why is this trading what appears to be at a discount? One reason might be that although it's being renovated now for a new 20-year lease, it's a slightly older building. It was built in 2006. Another reason might be it's $8.4 million. So these higher end net lease, single tenant net lease assets typically will trade at a slightly higher cap rate, just because there's less liquidity for that. If you were buying like a $1 or $2 million asset. And other than that, I guess you just have to dig into the asset and see if this is really if this price is justified or if this is actually a really good deal and it's a great discount.
So I think all those are really good examples. I've got questions. Do we think are the comps here, are they all kind of similar schools? Are they all Montessori schools, or are they're a mix, right, of daycare and education, right?
No, yeah, they're not all Montessori schools for sure. They're definitely a mix of daycares and like elementary schools. Usually those go together. There's a lot of them that do both.
Yeah.
But yeah, and a lot of these are, like I said, actually I didn't say that. A lot of these are smaller assets. So I think a lot of these are trading more in the like 3 to 5 million range. And some of these down at the bottom here, I think they're KinderCare, whatever the biggest franchise is for daycare. So they trade low. So that's pulling this line down as well. So there's many reasons why, this line could be a little bit higher if we were doing a perfect comparison, but I still feel like at a 7 cap, this thing is discounted pretty deeply. So either we're missing a lot of information or this is actually a really good deal.
Yeah, good. I think also we're looking at a time when tenants, and I'm biased here, full disclosure, I'm biased. What I'm about to say is completely biased. But if you're a tenant and you're working with your developer, then you have to be kind of reasonable and realistic with what your cap rate is going to be on the disposition side. So to me, I'm saying, hey, look, this is a realistic cap rate for a company that operates, I think, 95 plus locations nationally and internationally. It's just realistic. So their developer is putting it out there to sell so they can in turn reinvest and help hit their 40 plus schools goal, each year for the next, I think, 5 years. So I think what they're doing is setting realistic expectations, and the developer and the tenant are probably in tune. This may trade a little bit higher because, again, where we are in the market, people still don't know what's going to happen. But looking at this information, looking at kind of who the guarantor is, I'd want to know more on the financials, right? I'd want to know operationally kind of how it works, how they intend to open up 40 plus a year, right? Both domestically and internationally. What's their overhead for that? And in a little bit of other information, but I think this is a strong buy. I mean, I think this is really good. This is positive leverage, as you pointed out. There's not a lot that's on the market today that we're seeing where you can get that. The only negative I see is the price point. For me, this is a large investment to put $8.5 million into this. But if you believe in childcare, if you believe in the growth of childcare over the next decade or so, I think this is a great play. This is a great market with what I believe to be a good company. I think this is a buy.
Yeah, I agree. I agree as well. From everything we've seen here, and again, obviously, we'd have to dig in deeper before you do any serious offer. But yeah, it looks like a good deal. It's a much better deal than most of the stuff we've seen in the last few weeks. So I also would call it a buy for the right investor.
Good. Excellent. Anything else on this, Tyler?
I think that's it. I think we're done with Montessori for the week.
Good deal. Well, thanks so much for another week. And if anyone's interested in exploring this or underwriting this even deeper, please let us know. Contact myself or Tyler, and we'll be happy to help you. Again, all of these are listings that are out there for sale. These are not listed by us. So what we're trying to do is just kind of show a broad view of the different tenants that are out there in a single tenant net lease space, and introduce those to anyone who's interested in this market and asset class. All right. Thanks, Tyler.
Okay. All right. Cheers, Winston.
Cheers.